Welcome to this explainer. Let's demystify a massive finance question. What exactly is a bond?
Well, what do you think impacts your mortgage, car loan, and savings rate every single day?
It's the bond market. Globally, this massive financial engine hit a staggering $145 trillion in 2024.
Let's strip away the jargon. A bond is literally just an IOU. You're lending money to an issuer.
Okay, every bond has three key pieces. First up is the face value.
That's the initial loan amount, say $1,000, that you'll eventually get back.
Second is the coupon. Basically, think of this as your reward for lending out your cash.
It's a fixed interest rate the borrower pays you, like a nice steady 5% every year.
And third is the maturity date. This is basically the finish line for your investment.
It's the total lifespan of the loan, maybe 10 years, when your original money finally comes back.
So who's actually borrowing this cash? Usually it's governments or giant corporations funding their growth.
It's a classic trade-off. Governments offer safety, while corporations dangle higher yields for taking on more risk.
Now, crucially, a bond's price and its yield are locked in this constant seesaw relationship.
When overall interest rates rise, older bonds with lower rates lose their appeal, so their prices drop.
But if rates fall, your older, higher-paying bond becomes a hot commodity, driving its price right up.
You know, inflation is the silent threat here, slowly eating away at that fixed future income over time.
Which brings us to the ultimate question. Why choose bonds over the thrill of the stock market?
Well, they provide dependable income, smooth out market bumps, and offer protection during a corporate bankruptcy. Because they act totally differently than stocks, they become a vital safety net during crazy market volatility.
Essentially, bonds serve as the absolute backbone for a healthy, balanced, long-term investment strategy.
So, knowing all that, are you ready to add the stabilizing force to your own financial setup?